Another concept in housing finance that caught on some years ago but has now kind of died down because of the RBI and the National Housing Bank frowning on it was teaser rates. Teaser rates have their origin in the United States of America, where what would happen is a lender would offer a very low, below market teaser rate on the interest that he charges for the housing loan for the first 1, 2, or 3 years. It was a double-edged incentive to individuals to move or take loans from that lender. One, because they got lower interest rates. Two, it was also an incentive to move your loan out from a lender who is not offering teaser rates to this bank which is offering teaser rates. Now there is a big catch in this, and that's what you have to be careful of. A teaser rate, say for example in today's market, is say 50% lower than the normal interest rate. So if the normal rate is 8%, let's say the teaser rate for the next 2 years is 4%. Sounds extremely attractive, and you will see very clearly why people would get attracted to move their loans or take loans from these kinds of lenders. What the lender, you as a lender, have to be careful of is that when you do a credit appraisal on the individual, you work his eligibility out based upon not the teaser rate but on the actual rate that will be chargeable to the individuals if he was not to take a teaser rate. The reason is because what would happen is that you would appraise the person at 4%, for example, and give him a higher eligibility, which is very attractive for you because your book grows. It's very attractive for the individuals because he gets more money. However, 2 years later, when the interest rate changes, the EMI actually can go up by 40, 50, 60%. And then there is the issue of servicing. The person might not be able to service the bounce back of the interest rate and therefore the bounce back of the EMI that has happened because the teaser rate period is over. Having said this, the teaser rate at the moment at least is a thing of the past, but it is something you as a lender and you as a borrower must be aware of and keep it in your mind if you ever comes back or it comes back and you are tempted to actually go for a teaser rate loan. Probably one of the more important concepts we need to talk about is a fixed interest rate versus a floating interest rate. Now first, let's understand what the word fixed and floating means. A fixed rate is where the interest rate on your loan is fixed and does not change for the entire term of the loan or for a fixed specified period, maybe the first 5 years. A floating rate is where the interest rate changes depending upon various market conditions, which we'll talk about shortly. Now, when housing finance as an industry started in India and interest rates were not that market driven but used to be fixed interest rates on loans was the given standard. You took a loan at say 10% and you paid the same 10% for the next 15 years or 20 years in which your loan was not being repaid as yet. However, as housing finance and raising of funds by housing finance companies became integrated with the overall economy, it became necessary for banks and housing finance companies who were lending for housing to introduce the concept of a floating rate. This floating rate normally is linked to either an internal cost of funds or alternatively to an external benchmark. A benchmark can be something like a repo rate, or it can be the State Bank of India's lending rate and such other rate that is not in the control of the lending institution. The advantage of having an external rate is it is seen to be independent and therefore raises some confidence in the borrower. However, the downside is that your own cost of borrowings and your own internal cost of funds might not be completely connected to this external bench. Many institutions and the Reserve Bank of India have tried different ways to establish fair play versus actual financial implication to the lender. Now, what you also have to understand is that the floating rate can change for two reasons. One, either because the bank changes its retail lending rate, and the other is it maintains its retail lending rate but increases or decreases its spread. For example, if the prime lending rate of say a particular bank is 6%, it doesn't mean that you will get a housing loan necessarily at 6%. What the bank will do is it will add its own cost of funds, its margin, and then add it to the prime lending rate, and that becomes the rate at which you get your loan. So let's assume they add 3%, and therefore your rate from 6 goes up to 9%. Now your loan is at 9%. As markets change, as interest rates vary, the bank will take a position on two aspects. One, whether the spread needs to change. So for example here, from 3% they might bring it down to 2.5% or increase it to 4%. If they do that, then what will happen is all future loans that they make will now go at the revised spread being added to the lending rate. So in this case, from 6%, the marginal rate is not changing, but the 4% spread makes the new loan at 10%, or a 2.5% spread makes the new loan at 8.5%. This is typically applicable to new loans being booked after the announcement of the rate. However, sometimes the bank will also change its prime lending rate. For 6%, the 6% might actually become, say, 7%. If that happens, then it is not only the new loans that are getting booked at the new rate, but the entire old book is getting repriced. And therefore, existing borrowers who have taken loans 1 year, 6 months, 2 years, or even 1 day earlier will now get a new rate. It could be lower because 6% has come down to 5.5%, or it could be higher because 6 has gone up to 7%. Now, as a borrower, what should you do? And there are different considerations that come into play as to what you should do and what kind of a rate you should take. Now, before we discuss the pros and cons of fixed rate versus floating rate, the first thing you have to understand is mathematically, a housing finance company or a bank will always charge a slightly higher rate on its fixed loan and a lower rate on its variable or its floating rate. It's also called a variable rate, just for your information. The reason is because you're paying a premium for the fact that you are locked for the next n number of years. However, the floating rate or the variable rate might be, say, at 0.5% less. The advantage of the fixed rate being locked is that you are not subjected to external variances and volatility that happens in the market conditions. The fixed rate allows you to sleep well and not worry about what is happening. However, if rates go down, then your sleep is broken, because now you're still paying the higher rate, whereas the rest of the market has got the benefit of having opted for a floating rate, and actually the rate has come down now. In a fixed rate, it is easy for you to plan your financials, your cash flow and your budgets. In the floating rate, while yes, you can, but there is always that chance that your rates might change and your cash flows might change. Now, it's not that interest rates on the floating and the variable change every day. There is something called a reset period. That reset period typically is 3 months or 6 months, and banks and HFCs will look at these interest rates on the variable rate on those periods of reset. Every 3 or 6 months, they will look at their own cost of funds, their margins, their borrowing costs, and then decide whether they should reset the loan, reset the margin, or reset the primary lending rate itself. So there is a reset period. So this ends the module that we have on the concept and mathematics that goes into housing finance. Trust me, it's an extremely important component of you as a lender and for you as a borrower. You need to understand all the nuances, and sometimes as a borrower, you might be in conflict with your thought process compared to a lender. You must work what is best for you. As a lender, your internal credit policies will decide some of this, and as a borrower, you have the market choice to decide which lender you want to go to based upon these various aspects. My sincere suggestion is apply it in your day-to-day job if you're a lender. If you are a borrower, please look at your current options and then decide whether you want to change your lender or you want to prepay a part of your loan. These are things that you need to look at. If you're neither a borrower or a lender, then you should be aware that these are aspects that you will decide when you actually do decide to take a loan. I also recommend that you go through this module one more time more carefully using real life examples. As a lender, you will have multiple files that you have processed. As a borrower, you've probably taken a loan or you plan to take a loan. If you do or you have, then please note down these points and decide on your lender basis the plus and the minus of each of the points that we've talked about.